strong order inflow, profit after tax, and revenue growth in the first quarter of financial year 23-24. That's Larsen Toubro's result in a nutshell. The shares have reacted positively to the result and also to the big bang announcement on the buyback that the company has announced. It's first in and also something that the industry has been waiting for. Joining me today is Chief Financial Officer of Larsen and Toubro, Mr. R. Shankar Raman, who will not just take us through the numbers for the quarter, but will talk to us about the road ahead. Hi, Mr. Raman, how are you?
I'm fine, thank you. Good morning.
Welcome to Money Control and a very strong set of numbers in the quarter indeed.
Yeah, a lot of hard work that has gone behind it, but happy to see the results.
Mr. Shankaraman, before we get to the results and the company's performance, let's talk about the development that has got everybody talking, and that is, of course, the share buyback. Now, you have announced that you will buy shares worth up to 10,000 crores at a maximum price of rupees 3,000 a share. This share buyback, you had planned a similar thing a few years ago, which didn't go through because SEBI had some reservations on the debt, given that they were taking into account L&T Finance debt as well in your consolidated numbers. How is this buyback different from that? And in terms of the approvals needed, what would be different this time, and why are we confident about going through with it this time?
Since the last time, I think a lot of regulatory clarifications have been obtained. The Companies Act last time over spoke about the entity which is going to do the buyback, whereas SEBI looked at it as a group. And in our group, financial services is part and parcel of our group, and that is a debt-heavy business. So the debt of financial services was aggregated at SEBI's headquarters, whereas the Companies Act excluded them. So there was a bit of a confusion on what defines the debt equity post buyback. But since then, we have worked with SEBI, and SEBI has subsequently issued clarifications and guidelines, which now makes it very clear. And another big change is, I think, while making all these changes, SEBI also have said that so long as the regulations are met and they are certified by an appropriate agency, SEBI just needs to be kept informed. There is no approval that is required from SEBI. So to that extent, the process has become simpler and more predictable.
Help me understand what's the rationale behind this buyback right now. I mean, what exactly are you aiming with this buyback?
It's got nothing to do with timeline or share price. Let me clarify. I think part of that Lakshya FY26 plan, and the strategic plan that we drew between FY21 and 26, had ROE improvement as a key target. And the ROE improves because of two things. One is the businesses being run more profitably than in the past. And secondly, the capital intensity in the balance sheet reduces. So a combination of return accretive business and capital divestment of capital heavy items in the balance sheet would actually lead to this ROE improvement. So we are over the last 2 years working on both. We're trying to improve the profitability of the businesses. At the same time, we are also trying to get out of businesses which are capital heavy and hence not necessarily return accretive in the short medium term. Uh, Added to this is also the focus that we have brought on cash flow management within the organization. Today, I think every project site and every project director is conscious of the fact that the work done has to be reimbursed by the client in quick time. So, cash to cash cycle has received a lot of focus. So, that has brought down the working capital intensity in the company's operations from about 25-26% of the revenue. Today, we are running working capital at about 16-17% of the revenue. So the capital unlocked in this process and non-allocation of further capital to asset-heavy operations have resulted in cash surplus. Now, our job as a public limited company is to work for shareholders' value creation. And shareholder value creation happens both through capital appreciation of the stock prices as well as the yield of holding that investment going up. One way the yield can go up is through dividend, which we have stepped up. The dividend payout ratios are today upwards of 40%. They used to be 20, 25% a few years ago. And secondly, I think once we assess the requirements of cash for all our requirements going forward for the next few years, if the cash available is more than what we require, we think it is appropriate to return that cash to our shareholders. We are extremely confident that if the company requires capital, it should be able to go to the market and raise capital as and when required. But in any case, that doesn't seem to be the course for the next few years. So, that being the case, we thought that it is as good a time as any to do this. Also, I think it is important transition that's happening in the company. Our chairman, Mr. Nayak, after such a long and glorious innings, is stepping down. His term comes to an end on 30th September. And in a manner of appreciating his services, and he's always been a well-wisher of shareholders in terms of his thought process and actions. So we thought it will be also fitting that when he steps down, the shareholders have something to rejoice, both in terms of a special dividend that we are giving at 6 rupees per share, as well as this buyback offer.
Fair enough, Mr. Raman. I mean, L&T shareholders have been asking you for bonus shares for the longest time, but I'm sure the buyback will make them happy given the kind of price you are offering. Coming to the results now, your infrastructure projects business, of course, has done rather well in the quarter in terms of the orders that you have won in the first quarter of the fiscal. Help me understand what sectors are driving the growth, and also the one dampener there is the margin contraction. So give us some outlook on that. Which way is it headed, and what are the concerns here? Because you have mentioned that there are some legacy orders which cause the margins to shrink. So give me some color on that, please.
Sure. I think in terms of order winning, the sectors that have been most productive has been in the area of heavy civil infrastructure. It's mostly related with transportation, mobility related infrastructure spends of the government, be it the high speed rail, be it the dedicated freight corridor, be it the metro that cities are actually executing, metro projects that cities are executing. So, transportation has been a big area where both the allocation of funds by the government as well as the thrust that they have provided for making sure that the bids are fashioned and put out consistently has been a big help. We've also seen water as a major area where we've been able to grow our infrastructure business. And I think India, that way, is water stressed in many parts. We do have this uneven distribution of rainfall, which causes flooding and drought interchangeably. So, the many of the state governments, and this is more a state government project, many of the state governments have been trying to improve the irrigation facilities and the drinking water facilities, and we have benefited by that thrust as well. Uh, Over the last 5, 7 years, I think the government has been working to make sure that all villages are lit. So there has been considerable programs that have been rolled out in terms of rural electrification. Much of that are almost coming to an end now. I think much of India is lit now. But we had the benefit of the role of those orders as well in our infrastructure pie. Residential constructions and commercial construction has resumed. There was a quiet period after the pandemic, but now I think projects are coming up. Obviously, the markets have got far more selective. I think good projects sell and not so good projects do not make the cut. We're fortunate that some of these are under development. Also, considerable conversations are happening around development of public spaces. If you speak about the railway station development, the transit-oriented development, the airport development, interland connectivity for port, all of this has got to do with public infrastructure. Because I think we produce a lot of things, but a lot of things do not reach the markets because they rot on the way. The logistics management needs a lot of improvement. So all of this would mean investment in warehouse logistics. We're also building infrastructure for both healthcare as well as sports. So we're getting orders from the hospital sector. We're getting orders from the stadium sectors. So I think overall, on a very broad-based basis, I think India has now got on to realize that developing infrastructure all round is key for it to take advantage of the global market conditions, which point out to some say decade, next decade is the decade of India, some people say next century. I do not know what is true, but one thing is for certain. I think the keenness with which the project sponsors are approaching implementation of the projects has multiplied several times if I compare last 10 years to today. And that holds us in good state. And I guess it augurs well for our future as well. Talking about margins, I think the order book that we have is a mixture of orders procured during the difficult pandemic, post-pandemic, post-war time, and orders that we have won in more recent times. The orders that we have won in most recent times have the advantage of looking back at the price levels that have got inflated. So the pricing takes into account the inflationary conditions. But the orders that we booked around the pandemic time and just around the time when Russia went to war were all booked when the input prices were 30-40% lower than what they are today. So it was important that we execute the project, because unless we complete the project, there is not even conversation opportunity with the customers to see some compensation for all the additional cost inflations that has crept in beyond their estimation and beyond our estimation. So the results that you see over the last 2 quarters and maybe in the current quarter and maybe going forward in the next quarter or two would reflect slowly the exhaustion of the projects that we have taken under these conditions. And as we get into the fourth quarter of the current year, we will begin to see the mix of recently acquired projects coming into our revenue and hence contributing to margins in a fashion better than what they are today. So I'm confident about 24-25 being much better margin trajectory, and if we continue to win the orders the way we have been doing so far, I think we also hopefully will end the current year with a very healthy order book. And that sets in motion the pace of execution for the following year. So, volume growth as well as profitability growth is what we are forecasting for 24-25. But then we need to first complete our task for 23-24.
Talking of the task for 23-24, you have given a guidance of your revenue growth at 12 to 15% and order inflow growth of 10 to 12%. Now, in the first quarter itself, your order inflow growth has been 57% and your revenue growth has been 34%. And typically, first quarter is not really the strongest in a business like yours. So, are you looking to revise the target? Are you looking at exceeding the guidance that you have given?
We're also coming to terms with this volatility, Rachita. You are right that first quarter generally would not be a very large quarter for order intake, and second quarter will not be a very large quarter for revenue because of monsoon conditions, etc., etc. That's the historical trend. But what we notice is a lot of the first quarter orders that we have got have been the spillover of what FY23 was lining up to. uh, Given the nature of these orders being lumpy and large sized, I think slippage between the quarters take the percentages in a different trajectory. So I do not want to draw a conclusion at saying that 55%, 56% growth in order inflow in first quarter means that I would be able to sit on the lead right through the next 3 quarters. We also need to be conscious of the fact that some of the large state elections and union elections we are heading into, and hence we are not in a position today to predict the pace at which some of these ordering, etc., will be done. At the moment, we are targeting on orders that we want to win during the current year. So the pipeline for the remaining 3 quarters looks healthy. Our win rate, also the fact that whether all of these projects will go through is something that we'll have to wait and watch. So we didn't want to move the goalpost of guidance very quickly within 2 months of having announced it. Uh, we are happy that we have got off to a good start for the year, but we just want to wait and watch for a while before we get some certainty in our mind that we will do better than what we have guided the market for. Looks encouraging, but I would get into specifics after I get some more time on my hand to assess.
I can see your trademark cautiously optimistic view there coming through. Mr. Shankar Raman, the last time Moneycontrol interviewed you, you were talking about the pipeline. You mentioned it right now as well. The order pipeline you had said would be around 10 lakh crores for this financial year, and you were hopeful that the win rate would be around 15-20%. Any updates on that? Is the pipeline still looking that strong? And so far, has the win rate been comforting enough for you?
Yeah, the win rate has been around 20%. So I think we have fortunately been able to maintain the competitiveness at that intensity. Insofar as the pipeline is concerned, when we did a check as a part of this closing of the first quarter, the projects that are lined up adds up to about 9.5, 10 lakh crore, and 6.5 lakh. I think 6 lakh crore is essentially from infrastructure segment. About 3.5 lakh crore is from hydrocarbon. Hydrocarbon, as compared to the last time over, has grown in prospect pipeline largely because of the energy transition work that is happening all around the world, particularly the energy transition work that is happening in the Middle Eastern market. As we speak, we have close to $5 billion worth of orders that we have won in Middle East for the solar energy and the green energy initiatives. So I think if that trend were to continue, we could see the pipeline of 3.5 lakh crore that we are estimating coming to play. So with all the rest of the infrastructure area, the industrial capital expenditure, the construction mining sector, all of them put together maybe a lakh of crore. So I do see the 10 lakh crore assessment staying good if we have an uninterrupted 9 month for the current year.
Mr. Shankar Raman, you mentioned the hydrocarbon orders in the Middle East. I noticed a very interesting thing that you said yesterday during the conference call after your results, that Middle East is now changing from being a hydrocarbon centric economy to a more broad based economy. Can you explain what you meant by that, and how can that affect your operations there?
Yeah. In the past, largely, our order wins used to be in the area of oil and gas. It used to be either offshore extraction or pipeline or onshore processing. It used to be almost a single pony trick in a manner of speaking. But of late, the investments that Middle East is doing has changed trajectory. I think they want to develop a rail network. Two, they want to develop Middle East as a tourist destination. So a lot of facilities, including attracting large world stage games like the FIFA that Qatar hosted so successfully. So these initiatives are now changing the landscape of the investments. Now that they are looking at more people visiting Middle East, etc., they are investing also on the rail infrastructure. Middle East, as you know, is largely a road infrastructure-led, commercial real estate-led markets. Now they are also building cities, so which means residential buildings and townships will develop. Now that the entire world is talking about sustenance and green initiatives, Middle East realizes that it is extracting and exporting lots of fossil fuel. So to compensate, I think all the new builds that they are doing is being done on the back of solar. We do expect Middle East also to invest in downstream industries like hydrogen and green ammonia and stuff like that. So hence I find that the investment pattern that the Middle East is taking, particularly Saudi Arabia, is refreshingly different. Fortunately for us, it plays to our strength. All that we do well in India are the areas that they are now investing in. So we do hope that we will stay pre-qualified for all those opportunities. And these are typically very large opportunities as compared to Indian opportunities. The size of project is a billion, 2 billion, 3 billion quite easily. So we are also hedging our bets by trying to form partnerships, work in consortium, to make sure that we do not have any excessive risk loaded onto our balance sheet in this quest of growing scale.
So more opportunities in Middle East as well. That's an interesting space, and we'll keep an eye on that. Another thing that one wants to understand is your high tech business. There has been some deferral of orders in terms of your heavy engineering and defense orders. In the rest of the year, do you think it will make up for it? What are the laggards here?
I think the large investments that were planned in India, both by public sector and private sector, in the area where heavy engineering would have supplied equipments, has been the reason for slipping on orders in first quarter. We do believe it is difference and not completely abandonment of the project. We have not heard anything to that level. So maybe in the subsequent quarters, what we missed out in quarter one could come through. As far as defense is concerned, I mean, we have spoken about it in the past. It's always delay prone because of the layers of approvals that a particular project needs to take, and the fact that the government is keen on promoting private sector to collaborate along with the existing public sector in defense production augmentation also has its own complexities, because from a mindset where everything for defense used to be catered by public sector to co-living with the private sector, who by structure are far more efficient, faster, and hopefully cheaper, less expensive as compared to public sector, actually creates complexities in decision making process. Because while promoting private sector, the government cannot be seen as demoting public sector. So some amount of skill assortment is being done. Those which the public sector are good at doing, the orders will go the public sector way. Those where the private sector is efficient and good will go the private sector way. So some of the orders that we were expecting in defense in quarter one have got deferred. We do believe that we would get those in the remaining portion of the year.
Ms. Shankar Raman, help me understand. You have made substantial progress with your L&T Hyderabad Metro project, and you have already chalked out a plan for Nabha Power divestment. In this financial year, what level of divestment can we expect? What kind of funds are you expecting to come in from divestments in this financial year alone?
I think we will hopefully complete IDPL. I think that all the road concessions that we are holding through L&T IDPL, where we have signed a definitive agreement with the Edelweiss group, we need to complete. Various approvals are underway. It's a tedious process because it's about 10, 12 assets, and each asset has its own string of approvals. So we're working at it, and that is something that we will complete this year. Hyderabad Metro, I think the effort this year would be to make the asset better and better. With every quarter passing, we are walking that extra mile to make sure it gets better. And it has been so that way. I think the status last December as compared to last March, as compared to this June, things have moved both in terms of ridership as well as in capital structure. I think we should continue to do that and close the year on stronger ridership and lesser debt. I think it might take a year more effort thereafter before we can even put it on the table for a potential investor, because the investor would like to invest when he sees a balanced capital structure as well as proven ridership. And this being such a large project, 20,000 crore project, we might have to give ourselves this couple of years to get that done. So I don't expect divestment of metro to happen in this year. As far as Nabha is concerned, the asset is performing very well. Punjab state government is dependent quite heavily on this asset. Almost 90% PLF is what we are running. So on merit-based dispatch order, priority is given to the output that we generate in Nabha. Nabha Power is also turned profitable. It is contributing 1,000 crores a quarter of revenue and 100 crores a quarter of profits. But the fact is, it is a burning coal, and hence not necessarily a priority sector for investors to come in. So we're still holding our hope that at some day, just the efficiency of the plant and the robustness of the PPA We'll find some investor who's looking at some annuity yield out of this asset, but difficult to find a single asset owner because normally these investors would like to look at a portfolio of assets. So they need to find more similar plants which are equally efficient, which are equally robust in the PPA before they pool them together and invest. So I think it's going to take some work, but at the moment it is not causing any financial stress to us. So we're not sort of blinking too early on that.
Mr. Raman, you gave me a very broad view of the infrastructure space when we were talking about your infrastructure projects business. If I were to ask you from where we stand right now, what are the top things that are making you bullish about the India story?
Well, I think need to feed hungry mouths, need to diversify growth, make it more inclusive, etc. seems to be a common theme among the political dispensation, regardless of the parties. I think people have come to realize, and I think demonstratably it has been proved that you create more employment, you improve your tax to GDP ratio. So the focus is on creating employment. And if you look at employment creation, it cannot be that half a dozen centers or a dozen centers in the country are the only hubs where employment opportunities exist. This has to be taken deeper into the country. If you want to take it deeper into the country, both people mobility and goods mobility becomes important. So as you get deeper into the country, then the infrastructure development to support these employment generating opportunity to subsist in those areas needs to pick up. So it's actually one feeding on to the other. So the broader theme that the government and the bureaucracy seems to have bought in actually is the core for the investments that come in. According to me, India being an underserviced market even for infrastructure, much less for consumer, but for infrastructure, global funds are more than happy to invest. I think what we need to do is have policies and rules and procedures which make the investors feel safe and confident. We still today have work to do on the bureaucratic part of it. The approvals do take time, and we have to find ways to make that efficient. Intent is there. I think everybody wants to get on with it and see the project's completion, etc. But just the fact that we are moving in from one age of bureaucracy to another age of bureaucracy, and digital is helping in this process, is a time-consuming effort. And I think it also takes some generational mindsets. So I'm hopeful over the next 10, 20 years, the set of bureaucrats who will come to administer all the infrastructure development programs under the political leadership will possibly make it more attractive places for investors to invest. So once you have the need, once you have the money coming in, and once you have the policy framework supporting, then I think we need to do a lot of things wrong not to be bullish.
That's an interesting way to put it, Mr. Shankar Raman. Before we wrap up, I have one final question for you. I mean, you said that, among other things, the buyback is also, in a way, a salute to Mr. A.M. Naik, who is stepping down from company after a very, very long tenure. He would be stepping down in September, not too much time left. As somebody who's been covering this company for over 15 years, it feels like an end of an era. I want to know how are you people looking to bid goodbye to him, especially the senior management, because some of you have been personally mentored by him. So, what is the plan for his farewell?
Uh, Plan for his farewell is to have one more quarter of good performance because September 30th would be the quarter, and nothing makes him more happy than very strong set of outcomes. So I think that's one motivation immediately for the quarter. In so far as life after Mr. Nayak, I think we have been nurtured and grown both company wise and people wise by him and his philosophies and leadership values. So those are going to stay with us. I hope that we will be able to continue the cause of the company and its shareholders value creation targets. in a manner where people don't refer it as, Mr. Nayak's term and post Mr. Nayak's term. We just want to make sure that we build on the huge body of good work that he has done. And to maintain and take it forward is going to take enormous effort and belief. And I think he's very much around to guide us, and he's one of the most accessible persons. So I'm sure L&T, personally, all of us, if there is some guidance that we would require, we will always dip into him, and we will have his blessings and good wishes.
Mr. Shankaraman, as always, a pleasure talking to you. Thank you so much for your time and perspective, and wish you the best so that you can give Mr. Naik a good farewell gift in the next quarter. So, thank you very much. Thanks for joining us.
Thank you very much, Rajit.